All right, welcome to the Explainer. Today, we're going to break down a really simple, but honestly, an incredibly powerful tool that helps you peek behind the curtain of a company's finances to see how well it's really managing its debt.
I mean, it's the big question for any investor, right? A company can look fantastic on the surface, but hidden debt? That can be a total silent killer. So the real trick is, how do you spot that risk before it's way too late? Before we even dive into all the corporate finance stuff, let's just make this personal for a second. Think about your own money. You've got your income and you've got your monthly bills or loan payments. If you're earning way more than you owe each month, you feel pretty secure, right? But if it's a tight squeeze, any little unexpected expense can cause big trouble. Well, companies are exactly the same. And that's where this specific tool comes into play. The way we measure this financial safety net for a company is called the times interest earned ratio, or as we'll call it, the TI ratio for short.
So, what is it really? Put simply, the TI ratio tells us how easily a company can pay the interest on all the money it's borrowed. You might also hear it called the interest coverage ratio, but don't worry, they're the exact same thing. It all boils down to one question. How many times over can a company's earnings cover its interest payments?
And how do we figure it out? The formula is actually super simple. You just take the company's core earnings, a number called EBIT, which just stands for earnings before interest and taxes, and you divide it by its interest expense. This gives you a really clean look at how the company's actual operations are handling its debt costs.
Okay, so theory is one thing, but the best way to get this is to see it in action. So let's cook up two imaginary companies, we'll call them Company A and Company B, and see how this all plays out. Now take a look at this. What's really interesting here is that both of these companies have the exact same amount of debt, a one-core loan, which means they both have to pay 10 lakh in interest every year. But here's the crucial difference, their earnings. Company A is pulling in 50 lakh, while Company B is only making 20 lakh. And this chart just makes it so obvious, doesn't it? I mean, look at that massive gap between Company A's earnings and its interest payment. That is a huge safety cushion. Now look over at Company B. Whoa, that gap is much, much smaller. You can almost feel the risk just by looking at it. So when we actually do the math, the story becomes crystal clear. For Company A, we divide its 50 lakh in earnings by that 10 lakh interest payment, and we get a TI ratio of 5. For Company B, it's 20 lakh divided by 10 lakh, which gives us a TI ratio of just 2. So what do these numbers, 5 and 2, actually mean in the real world? It's simple. For every single rupee Company A owes in interest, it's actually generating 5 rupees in earnings to cover it. But Company B, it's only generating 2 rupees for that very same 1 rupee of interest. Big difference. And this is why that low number is such a huge red flag. I mean, think about it. Company B is basically walking a financial tightrope. Even a small dip in business could be a catastrophe. If its earnings just fell from 20 lakh down to 10 lakh, its entire profit would be gone, completely wiped out, just to pay the bank. For an investor, that is a massive flashing warning sign.
Okay, so we get the risk, we know what a scary number looks like, but as an investor, what are you actually looking for? What's the number that separates a safe bet from a really risky one? Well, the general rule of thumb, the number to keep in your head is 3 or higher. A company with a TIE ratio in this range is usually seen as having a healthy cushion. It can comfortably manage its debt, even if things get a little bumpy. So how do you use this wisely? First, just like we see here, you can start by screening for companies with a TIE ratio of 3 or more. Think of it as your first safety check. But, and listen, this part is absolutely critical. You can't stop there. You have to compare that company's ratio to others in the same industry. A big manufacturing company is going to have a totally different TIE profile than a software company. It's all about context. Sometimes a low ratio isn't a red flag. It could just mean a company is borrowing a lot to grow super fast. That's a different kind of risk, but one you need to understand. Context is everything here. So there you have it, the times interest earned ratio. It's a fast, effective way to get a read on a company's ability to handle its debt. It's your financial early warning system. A high TIE ratio definitely signals safety, but it also brings up one last important question. What other numbers do you need to look at to really get the complete story of a company's health?